Welcome back to the Mainstream Mortgages podcast. My name is Derek Vandell, and I'm joined again today with my business partners, Colton Boudreau and Peter Paley. On today's episode, we are talking about the Manulife One product. If you've never heard of this before, listen up because it's pretty interesting. The Manulife One product, Peter, what is it and how does it work?
Basically, it's an account. It's your primary checking account with your mortgage and home equity line of credit attached as a big overdraft. That's basically it.
Fair enough. Okay. And Colton, who would care about this Manulife One product? Who should be listening to this podcast?
I, I would say high income earners. We typically say about a household income of 150,000 is in the realm of where clients should be looking and interested in this product.
Or if you're
Okay.
really good savers and really cheap like me, it's also a good product for those people too, who are really good budgeters.
Yes, that's true. Um, okay, so Peter, how is the Manulife One different from a traditional mortgage? Is it even a mortgage?
Well, it kind of is. It gets registered on your title as a mortgage, but that's pretty much where the similarities end. Manulife, what they did with this product is they blended everything into one product. So it's all in one. It's your checking account, it's your savings account, it's your mortgage, it's your line of credit. And basically, the way it works is we try to calculate based on your household budget how much money you can sort of pay off your mortgage within 5 years. And it doesn't work like a traditional mortgage where you have a principal payment and an interest payment, or you have a separate line of credit over here where you make a separate payment. What this does is it takes all the income coming into your bank account. So your employment income, any self-employment income, any government benefits you get, that all goes into your checking account. And as that money is deposited into your checking account, you're no longer paying interest on that portion of the money till you spend it. So what Manulife does is they don't compound your interest like a traditional mortgage lender would, and they calculate simple interest. So at the end of every day, Manulife calculates a daily interest for that particular day based on the balance of your home equity line of credit portion, which they call the main account, and then they add it up every day till the end of the month, and what you pay. So if you're a good budgeter and you have surpluses in your household budget every month you're paying less and less and less interest on your mortgage and you're paying more and more principal. So it really is a way to destroy your interest. And the best thing for anyone interested in this product is to contact us and we'll do the Manulife One calculator with you and show you how it can um, really kick the butt of your existing mortgage if you are one of these either high income earners or excellent budgeters.
That makes sense now why you said that it's for high income earners or savers, because the longer they keep their money in their accounts, the more interest they save, right? On the Manulife One mortgage.
And the faster
So
your mortgage gets paid off while you still get to carry on with your life. Like it's kind of like double dipping the chip at the party and everyone being okay with it.
exactly. And so Peter, can you give us an idea of maybe how much faster someone can pay off their mortgage with a Manulife One?
So one thing that I like to do is when we go through the calculator process with the client is I sort of manipulate the calculator to see how fast they would be and I set the amortization for 5 years. And based on the client's household budget, it's going to tell me how fast they can pay off their mortgage. And with most clients, I'm finding that they have the potential to become mortgage free within 5 to 11 years. 5 to 11 years. And that's really just depending on your lifestyle. And we do still encourage you to save your money in your RSP and TFSA and live your life normally. But this is for people who are enjoying a really nice budget surplus that it just starts paying down your mortgage principal while saving you tens of thousands of dollars in mortgage interest. Because when you get a regular mortgage, we can tell you from day one exactly how much interest you're going to pay over the term of your mortgage, and it's a really big number every single time. And with this Manulife One, it's going to cut that down significantly. And for the average family, it's about 100 to $125,000 just in interest savings, and you pay the mortgage off 10 to 15 years sooner. Sounds too good to be true, and it kind of is. It's like one of those things where it's actually too good to be true if you're the right person for the product.
Sounds like where that saying comes from, the rich get richer type of product.
Or the good
So,
savers get richer.
yeah, true. So, Peter, is this a good product for somebody who has multiple debts?
Yes, but you have to hear us out on that because it's a good refinance product, and it's for maybe someone who maybe has a lot of equity built up in their home. They're in a position where they want to maybe take control of their finances. Like, Derek, you're right at that age yourself. You just crossed 40. There's your retirement's coming up fast in front of you, and you maybe want to take a really good look at your finances because your 20s and 30s, you had a really good time, kind of thing. So it's really for these people probably who are over 40 because they're in a good spot with their income level and probably have a good handle on their debt. Even if they do have some outstanding credit card or loans or whatever, you can put it all into this product and start attacking it right away. So maybe Colton can go in there with some examples of ones that we just did and the kinds of debt that we included.
Yeah, for sure. I mean, it's basically your standard debts, right? Like your car loans, your credit card debt, your lines of credit, any investment loans. They say your cheapest form of borrowing is your mortgage, right? So when you can include those high interest loans of 19% or maybe even higher sometimes, it's kind of a no-brainer.
It's a no-brainer.
Yeah. So, okay, next question. Peter, it sounds kind of like it's a line of credit type of account. Does that make sense?
Yeah,
Is it more like a home equity line of credit?
it is. It
Okay,
really is.
how does this Manulife One compare to other home equity lines of credit like the Scotia STEP or the TD FlexLine or others?
So they're all very good products, like all of our partners, Scotia, TD, MCAP, CMLS. They all have excellent home equity lines of credit. Those home equity lines of credit maybe aren't are for people who have specific situations that were that sort of tailored to that. But this Manulife One is just for someone who really who's going to pay their mortgage down probably really quick and wants to save the most amount of interest and um, are good savers. Like they can have a budget surplus. I mean, when I had this kind of product back on my last house, we bought it in 2019, and I had this set up really well. And by the time our 5 years were over, we realized we paid off like $365,000 of our mortgage because we are good savers and we are well budgeted. And we just sort of set it and forget it, like the food dehydrator guy. And we were actually really quite shocked. I had clients in the past who actually the very first clients I did this product for in 2013 or 2014 phoned me after a couple of years in a panic because they thought there was a problem with their mortgage. And they're like, Peter, this thing, we don't understand it. We're getting our statement. Nothing makes sense. And I'm like, okay, well, send me your monthly statement. So anyway, it was about 4.5 years after I set up the Manulife One, and they sent me their statement. But what had happened was they paid off their mortgage and they didn't realize it. Their account went from a negative balance to a positive balance, which is a cool feature of the Manulife One because it is basically your checking account. And when you do get to that positive balance, if you do pay off your mortgage quickly, then it's actually a high interest checking account. So instead of them paying interest, they were earning interest. And at the time, they were earning about 2.25% interest on the high interest checking account. And it was blowing their mind because they didn't really understand that they had paid off their mortgage.
That's crazy.
Yeah.
So if it's kind of like a home equity line of credit, is it possible for someone to maybe get like a regular fixed mortgage payment in the Manulife One? And would it make sense to do so?
Yeah, for sure. And that's really going to depend upon that whole calculator process that we do. Like the way I like to set them up and the way that I set it up for myself, which was not really intentional, was more of a fluke, was we kind of paid off our home equity line portion in that 5 years, and we still had our fixed rate portion. So that's what I like to do. I like to lock in what you're not going to probably pay off in the 5 years in the fixed rate, and that'll be like a regular mortgage, principal and interest. You can do that on any term, 1, 2, 3, 4, or 5 year term, and put the rest in the main account, which is the home equity line of credit portion, and let your budget surplus take care of that for you as you continue on. Like it's really quite quick how fast this works. And just wanted to also repeat that we still encourage you to contribute to your RSP and contribute to your kids' RESP and contribute to your TFSA while doing this. Like this is really meant for all your budget surplus to attack your mortgage interest. Because why keep 20 or $30,000 in your savings account earning 1 or 2% when you can be paying off your mortgage at 4% plus? It just makes sense.
Right. And so it sounds like it would be a mistake to just throw all of your money into this Manulife One because, like you said, you want to make sure you're still contributing to your RSP, TFSA, all those kinds of things. Um, what are the other types of mistakes that people commonly make with the Manulife One?
So like again, it's like that product selection for appropriateness. So if you're a spender and you got a new quad this year and you're going to need two new quads next year, probably not the product for you unless you're like really quite wealthy. I think that's a big mistake where people think it's going to be some magic bullet, which it is for the right person, but if you're the wrong person, it can really keep you in perpetual debt for a really long time. And I would say that's probably the one mistake. It's also maybe not good for couples who keep their finances separate. So if you are a couple, for example, and everything's joint, this is probably going to work really well for you if you're the right person. But if you guys are separate, probably not going to work as well unless you each do your own budget and contribute a greater chunk of your income than the minimum expenses. I would say that's probably some of the mistakes that, not even mistakes, but like what you'd have to really consider when you're considering this product. And I mean, we just did one in December, and the client called me and he goes, I don't know if this is working for me. And I looked at his account and I'm like, well, you've paid $37,000 off your mortgage since December. He's like, I did? I'm like, you did. He's like, oh, this is working for me. But it's just hard to wrap your brain around it because we've been trained to just, we'll get the mortgage, pay your principal, pay your interest 25 years, 30 years, and call it a day. But this is a product that really works for you. And it works for Manulife too somehow, and everybody seems to really win at in the end. I mean, we had a pharmacist and his wife pay off their mortgage within 7 years. Like it was super fast. And the nice part is that if you do get to that point, you still have the line of credit set up. So if you ever need to make any major purchases, you can do so. If you want to loan money out to a family member or a friend, you can set up that loan. You can lock in the interest rate. You can have them pay you back. You can do all sorts of stuff that's really good. I mean, in a more in-depth um, section of this webinar, which maybe is not for today. Like you can set up tracking accounts for interest. Accountants love this. Commission salespeople love this. Professionals like doctors and lawyers and engineers love this product because it really gives them the flexibility to do it. Like we have an accounting client who set up his whole Smith maneuver, which like, I mean, we don't do as mortgage brokers, but he does as an accountant and he uses this product and he swears by it and referred us clients to do the same thing. It's a really great tool.
So you mentioned multiple times that a lot of people pay off their mortgage really quickly, like you said, 7 years in that most recent example you gave. But in the terms of money, how much money can people save with this product,
Well, it's gonna,
realistically?
but I mean, like when I do the average calculator, it's usually between 80 to $125,000 compared to the regular mortgage. And keep
Wow.
in mind, like we're not comparing apples to apples, like the Manulife One interest rate to the bank's interest rate. Like usually the bank has a better interest rate, but the way they compound interest and the length of time, it really tacks on a lot of interest. Where this is simple interest and the calculations based on not the full amount all the time, because as you're depositing money, you're paying less and less interest. Like even though it's fractions of pennies in some cases or just a few pennies, it really adds up to tens of thousands of dollars over the long term. Because don't forget, when a bank compounds your interest, you're paying interest on the interest, right? Like that's what compounding really is. And simple interest is, well, you're just paying what you owe for that day, and that's that. So those tiny little cuts that the Manulife One product does, just by the way by its the way it's set up, really adds up fast. The savings can really add up fast.
So here's an interesting question, and maybe I'll make this the last one, but if you're possibly saving like $80,000 compared to a regular mortgage, how does Manulife make any money off of people on this product?
Well, I mean, they're still making their interest that they charge, right? They're just not compounding it. So that little bit of daily interest that you pay, like whatever it is, like 30, 40, $50 a day, like that still adds up. Like, I mean, you're still making money. And then don't forget, Manulife's a full insurance company and a full bank with investment advisors and a ton of investment products. So if they can get rid of your debt fast and can get you into on the money side or the insurance side, because everybody needs proper insurance, I mean, they're going to make money on both sides of their business. So
Yeah.
why not help the people out and
I
let them
think another,
pay
yeah,
faster?
I think another realistic answer to my own question there is that a lot of people do misuse the product and they don't actually pay off their mortgage that quickly. And I've heard stories of people with the Manulife One who didn't understand how it worked and they ended up, being in debt for who knows how long, never paying down their mortgage principal at all for
For
years, right?
spenders. Yeah,
Yeah.
it's definitely
Yeah.
not for spenders. But I
So
mean,
definitely,
also gives
um,
you a lot of flexibility as we're all commission salespeople here too. Like we don't know if our year is going to be really great or really not. Like, I mean, we have a banner year this year. It's a feast year. Next year can be a famine year. And this gives you access to your home equity all the time. So if you do run into a challenge or you do have like a employment hiccup, especially for us commission salespeople, like, I mean, it's nice to have that. I mean, when Alex ended up selling the bakery, he wanted to take 6 months off. So we could do that because we had paid so much down on our mortgage. We could just live off our line of credit till we decided what we wanted to do for our next move, right? So, I mean, it's so flexible and um it's so good for the right person and you if anyone's watching this, like with both of you watching this, you'd be remiss and not to at least explore it to see if it's the right product for you. Colton, I'm
yeah.
so sorry I hogged all the questions.
It's all good.
I like this. I like this product a lot. As yeah.
Yeah, so I would say that it's actually less of a mortgage product and more of a strategy. So please reach out to a mortgage broker. Uh, if that happens to be the Mainstream Mortgage team, please reach out to us at 431-482-2187. And you can also email us at greatrates@mainstreammortgages.com. Thanks for listening, and we'll see you on the next one.